All right, my friends, you need to follow Brian Westbury over at First Trust Advisors. I'll share with you the website here in just a second. But so I'm going back to my book, and I hate to keep referring to this, but this is just fundamental. It's almost like when I first read Nassim Nicholas Taleb, I said, no one else is talking about that, what he's talking about. No one else has talked about this. Even to this day, this book was written in 2009. 10 years later, I don't see any economist, never mind freaking financial analysts, talking about the balance sheet recessions. Um, it's just you gotta. Sorry, I'm not being very loud. It's 6:30 in the morning. The sun's just barely poking out, and everyone's still sleeping in Shay Scanlon. But anyway, I want to read this to you because this is freaking nuts, man. It's fundamental. So he's talking about balance sheet recessions are silent and invisible. One of those who's most aware of the problem is the CEO, but they're the least willing to talk about it. The CEO of a company with negative net worth that is struggling to pay down debt would never discuss such matters with the public outside of this firm. This sort of talk could spark rumors that would cut off firms' access to credit and force it to settle accounts using cash. Nor can management discuss these issues with employees. The moment it was announced that the company was technically insolvent, the best employees would leave for other businesses. Let's see. As a result, only a handful of people within the company know the true state of the balance sheet: financial directors, the immediate staff, and the CEO. These people want to keep the information under wraps because they know the problem will be eventually resolved as long as the company remains cash flow positive. When speaking with outsiders, they discuss only positive news, such as new products or planned investment. In the meantime, they continue to pay down debt. Now, here's the critical thing. Creditors, the banks, do not want to discuss these issues either. If it becomes known that a borrower is technically insolvent, loans extended to the company will become bad loans, and the lender will be forced by government regulators to cut off credit and to try to collect on existing loans. The bank, well aware that time will solve the problem as long as the business continues to generate cash flow, would naturally prefer to avoid this outcome. So the senior corporate execs and the bankers who understand the nature of the problem refuse to talk about it. This makes balance sheet recessions inevitable or invisible and inaudible. You don't know what's happening. So remember, if it becomes known that a borrower is technically insolvent, the government regulators will force that bank to call in their loan. That's exactly what happened, man. And why do we put so much faith in our federal government to solve the crises of whatever it is, the business cycle? That's exactly what happened in 2008 and 7. Good loans were being paid, but the regulators forced the banks to call them in because the firms were technically insolvent because the asset bubble, it popped. And so now you're sitting on, let's see, you borrowed $1 million to buy this asset car wash. And now the car wash is worth $600,000 because of the fact that the asset bubble burst. But you're still good. You still have customers. Everything's still fine. It's just you have a negative net worth. And now at negative net worth, the government is saying you can't have that. We got to raise capital. We got to increase equity. And so now you're calling the loan. It's nuts. And I'm sitting there, I mean, even Barney Frank knew this. That's why he started the whole thing of at least suspending mark-to-market accounting. That's why I say Barney Frank saved capitalism. I sit there, how much faith do we put in our betters, essentially? It's insane to me. And yet, even people today on YouTube say, Josh, these people have studied this. They know it better than you. And I'm like, but they're wrong. Doesn't mean I'm right. It just means, why do you put so much faith in these people? It's crazy. So anyway, I want to show you something here. And I just woke up about an hour ago. So if I'm looking out of source, apologize. Follow First Trust and my man Brian Westbury and Bob Carey. Brian Westbury is the chief economist over at First Trust. And this is the first guy who made me aware, essentially, what now I've come to be known as the balance sheet recession and mark-to-market accounting. And he was, I'm telling you, he was saying that way, way, way back before, and still no one talks about it. They talk about how Paulson, Geithner, Bernanke all saved us from ourselves. And nothing could be further from the truth. It's like saying the Federal Reserve saved us from the Great Depression or FDR saved us from the Great Depression. Nothing could be further from the truth. But Westbury saw it. He said, we are mark-to-market accounting, and that means when you have an asset bubble that bursts, you're essentially saying you have to keep so much equity relative to debt. So much equity, so instead of debt to equity, equity to debt. And now the equity has fallen off a cliff because the balance sheets are blown up because the asset bubble has burst, but you still have the same amount of debt. So now you're, in this case, again, debt to equity, equity to debt, however you want to look at it. But what used to be about 80% debt to equity is now a 200% debt to equity, which means you don't have any equity. You have a negative net worth. You're insolvent on a balance sheet side, but you're still making your payments. So now our government says, go out and make sure they raise money to pay those, to get them back to being solvent. You can't, but they don't have the cash to do that. So the only option is to go bankrupt. And Westbury is a guy who solved this. He saw it, and you should follow him. He's a. I mean, I don't want to say he's an optimist, but there's a lot more optimism. I mean, this is personal consumption expenditures. I mean, just personal income rose by 0.1% in July. Wages were rising, and consumers were spending to start the second half of 2019 on strong footing. While the 0.1% increase in personal income in July fell short of consensus estimates, incomes are up a healthy 4.6% in the last year, and up a faster 4.9% annualized over the past 6 months. And incomes would have been higher in July, but for a 1.8% decline in interest income that partially offset rising wages and salaries in the private sector. So if you don't have bank CDs and whatnot, you're making big. Your income has increased. It's just the lower interest rates have minimized that to some extent. If you have a lot of interest income. We think recent survey softness was largely due to trade-related headlines that temporarily stoked negative sentiment and fear, and do not suggest a significant slowdown in actual production. In other words, inflation is moving towards the target and already there under the more reliable core measure. Unfortunately, today's data will probably do little to change its leanings towards cutting rates. Is a rate cut needed? Not at all. The U.S. continues to benefit from the tailwinds of tax reform and deregulation put into place over the last 2 years. And the economy is on track to once again grow near the fastest annual pace in more than a decade. There is no recession on the horizon and no need for government intervention. I cannot... In other news this morning, the Chicago Purchasing Managers Index, a gauge of business sentiment, rose to 50.4 in August from 44 in July. Plugging this data into our model suggests that the National ISM Manufacturing Index, scheduled for release next Tuesday, is likely to rise modestly to 51.3. And so that's ISM. Anything time it's over 50 is considering I don't want to say booming, but certainly a growing economy. Anyway, so you got to read Brian Westbury. Those crazy, man. You got to read this guy. The flailing Fed, exactly. Because look, if you need a antithesis to the bear, he's the guy. Now he's not, again, Pollyanna, but just the guy. He just called it. He knows what's going on. And he's just a human being. He doesn't know any better than you and I. But anyway, all right. I just wanted to go on that. The idea that the government is going to save us from all. The flailing Fed. I got to read that. I probably won't read it here right now because I got run out. But where was that? The flailing Fed. Maybe we'll just take a gander. For the past several years, under the leadership of Powell and Janet Yellen, the Fed claimed that it was data dependent, but the decision last week to reduce short-term rates by 25 basis points tore that narrative to shreds. Yeah. All right, I'm going to get out of here. But The Antidote to Conventional Wisdom, the First Trust Economics blog. You got to read it. All right, we'll see you.